Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Compass Diversified quarterly report. Compass Diversified market capitalization of $0 billion is materially smaller than most of its industry peers of roughly $7 billion. Compass Diversified trades at a higher price-to-book ratio of 9.8 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company exhibits a very high leverage profile, with liabilities accounting for 84% of total assets. This elevated debt level warrants heightened caution, as it may limit financial flexibility and increase risk during economic stress. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 18.55%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. Compass Diversified is a private equity firm that specializes in investing in various businesses across different sectors. The company focuses on acquiring controlling ownership interests in leading industrial or branded consumer companies through add-on acquisitions, buyouts, and industry consolidation. The firm invests in a wide range of industries, including textiles, apparel, luxury goods, trading companies, distributors, manufacturing, distribution, consumer discretionary, commercial services, supplies, capital goods, leisure products, consumer services, consumer staples, household durables, business services, infrastructure, healthcare, safety and security, electronic components, food and food service. Compass Diversified typically invests between $80 million to $800 million in companies, with an EBITDA of at least $10 million per annum. The firm prefers to invest in North American-based companies and holds its investments for 5 to 7 years before exiting. With a strong presence in the market, Compass Diversified has established itself as a significant player in the private equity industry. The company's investment strategy involves acquiring controlling or majority stakes in portfolio companies through its balance sheet. This approach enables Compass Diversified to drive growth and profitability in its investments, while also providing a platform for future acquisitions. With a proven track record of success, Compass Diversified continues to be a major force in the private equity market. The list of businesses and services that Compass Diversified provides includes textiles, apparel, luxury goods, trading companies, distributors, manufacturing, distribution, consumer discretionary commercial services, supplies, capital goods, leisure products, consumer services, consumer staples, household durables, business services, infrastructure, healthcare, safety, and security, electronic components, food service. The stock price of Compass Diversified Holdings, CODI, has crashed by over 74.51% in the past year due to a series of revelations regarding financial irregularities and fraud at its subsidiary, Lugano Holding, Inc. The crisis began on May 7-8, 2025, when the company announced that its financial statements for fiscal year 2024 could no longer be relied upon due to an ongoing internal investigation into Lugano. This disclosure caused a significant drop in CODI's stock price, with over 60% plummeting in intraday trading on May 8, 2025. The investigation uncovered irregularities in sales, cost of sales, inventory, and accounts receivable, as well as unrecorded financing arrangements within Lugano. These events also triggered securities fraud investigations and class action lawsuits against Compass Diversified Holdings. The situation worsened with the delayed filing of its Cone 2025 Form 10-Q, which led to restatements for fiscal years 2022, 2023, and 2024. The company also suspended dividend payments in May 2025, removing a significant income stream for investors. In November 2025, Lugano Holding, Inc. filed for Chapter 11 bankruptcy protection, further eroding investor confidence. The cumulative effect of these events has severely damaged investor confidence, leading to the substantial decline in Compass Diversified Holdings stock price. The company's noncompliance with corporate governance, listing standards, and failure to hold an annual meeting in 2025 have also contributed to its financial woes. The primary drivers of revenue growth or decline can be identified through a review of the key points extracted from the provided summaries. On one hand, revenue growth is attributed to several factors including acquisitions, market share gain, innovation and targeted investments, and increased sales in specific product lines such as archery. On the other hand, revenue decline is primarily driven by lower demand in various markets, material and production restraints, and category softness due to tariffs on pricing. Furthermore, certain segments have experienced declining revenue, including Velocity, Arnold, and Sterno, while others have seen significant increases, such as Lugano, the Honey Pot Co., and Alter. It is also worth noting that net sales increased by a marginal amount of $276,000, primarily due to new programs with European and Asia brand partners. Additionally, adjusted earnings decreased slightly, while adjusted EBITDA saw an increase in 2025 compared to the previous year. The net income of a company underwent significant fluctuations over the past 2 years. Initially, it decreased by 26% for 3 months and 15% for 9 months in 2024 compared to previous periods. However, in 2025, the net income increased by approximately $52.5 million, marking a 9.4% rise from 2024. Despite this increase, there was still a decrease of $40,099 in 2025, indicating that the company's financial performance is not yet stable. The profit margins also experienced changes, with gross and operating income margins decreasing by 0.5% and 0.1%, respectively, for both 3 months and 9 months periods in 2024. However, there was an improvement in one segment's operating margin, increasing from -122.4% to -100.4%. On the other hand, another segment's operating margin decreased from 11.3% to 7.3%. The net loss from continuing operations margin also increased from -14.1% in 2024 to -18.4% in 2025. The conflicting information across different pages highlights the complexity of the company's financial performance. Nevertheless, it is clear that the company has faced significant challenges in maintaining stable net income and profit margins over the past 2 years. The company's operating cash flow has been a subject of mixed reports. While most pages, including those detailing specific years, 2024 and 2025, show negative operating cash flow, ranging from -$53,834 to -$134,980, there are instances where positive operating cash flow is reported. Pages 22 and 62 specifically mention the company generating positive operating cash flow in certain periods or contexts. However, these conflicting statements may indicate inconsistencies or updates within the financial report, making it challenging to determine a clear trend. The company's debt level and interest expenses have undergone significant changes over the past few years. The total debt has increased by $104,562, bringing it from $1,774.29 million to $1,878.85 million. This indicates a substantial rise in the company's financial obligations. Furthermore, the interest expenses have also seen a considerable increase, with some summaries suggesting an uptick of up to 130.6%. While there is conflicting information on this front, it appears that interest expenses have generally risen significantly. The performance of Ergobaby's segments and regions varied in the given period. In terms of sales, Ergobaby reported strong numbers, with net sales reaching $21.8 million for 3 months and $71.5 million for 9 months. However, operating income was not as impressive, with a loss of -$935,000 for 3 months, but a profit of $629,000 for 9 months. The performance of the regions is less clear-cut due to the lack of specific numbers provided in the summary. North America, Europe, Asia-Pacific, and Latin America are all mentioned as segments, but no sales or income figures are given. This makes it difficult to assess their individual performances. One segment that did experience poor performance was Lugano, which involved a related party transaction with misrepresented payments totaling $8.8 million. Additionally, high net purchases from a related party vendor were made, amounting to $1.2 million and $5.2 million. These issues highlight the need for improved financial management and transparency in this segment. Management's outlook on the company's strategy is centered around a short-term focus on debt reduction and maintaining cash reserves, while also operating under certain restrictions. In the long term, they aim to acquire businesses in the healthcare sector, drive sales growth through new product development and international expansion, and increase free cash flow. Key initiatives include strengthening liquidity and reducing leverage through operational and financial efforts, pursuing strategic transactions involving real estate, and maximizing recoveries from Chapter 11 proceedings. Financially, management expects capital expenditures for 2025 to be between $50 million to $60 million and believes that non-GAAP measures such as adjusted EBITDA and adjusted earnings provide a clearer understanding of their performance. Management is navigating the company through a period of financial stress while prioritizing debt repayment and maintaining cash reserves. They are also focused on driving growth through strategic acquisitions, new product development, and international expansion. The company has made several significant acquisitions over the years, expanding its product offerings and market presence. Notable acquisitions include Ergobaby in 2010, Arnold in 2012, Sterno in 2014, 5.11 in 2016, Velocity Outdoor in 2017, Alter Solutions in 2018, Boer in 2020, Lugano in 2021, Prima Loft in 2022, and The Honey Pot Co. in 2024. In addition to these acquisitions, the company has also made several strategic divestitures. In 2024, it sold Ergobaby and disposed of Crossman. Furthermore, in 2025, the company recorded an impairment loss related to Lugano's property, plant, and equipment, as well as right-of-use assets, following a triggering event. The acquisitions have enabled the company to diversify its product portfolio and expand into new markets, while the divestitures have allowed it to streamline its operations and focus on core business areas. The company's financial history reveals a commitment to shareholder value. One notable aspect of this commitment is the payment of dividends. This practice demonstrates the company's willingness to distribute profits to its shareholders, providing them with a return on their investment. In addition to paying dividends, the company has also engaged in share buybacks and other forms of capital allocation. Specifically, it has repurchased Series B preferred shares, Series A preferred shares, and allocation interests. These actions suggest that the company is actively managing its capital structure and prioritizing shareholder value. Concerns about inventory buildup or supply chain disruption have been raised in the context of Lugano subsidiary operations. The irregularities identified in sales, cost of sales, inventory, and accounts receivable recorded by Lugano, page 101, suggest potential issues with inventory management. Furthermore, the high inventory purchases at Lugano in 2024 due to restatement, followed by a decrease in 2025 after the investigation began, may indicate efforts to rectify past mistakes. The expansion of Lugano's operations and building of inventory to support salon growth, page 105, could be seen as a strategic move, but it also raises questions about the potential for inventory buildup. Additionally, concerns about inventory practices at Lugano Holding, Inc., page 106, add to the overall picture of potential issues. Some specific instances of purchases from related party vendors have been noted, including $0.3 million and $1 million in Q3 and YTD 2025, respectively, pages 64-65. While these transactions may not necessarily indicate inventory buildup or supply chain disruption, they do suggest unusual purchasing patterns that warrant further investigation. Overall, while some of the instances mentioned may be isolated or explainable, the accumulation of concerns about inventory practices and purchases from related party vendors raises red flags about potential issues with inventory buildup or supply chain disruption. That concludes the financial summary for Compass Diversified. Feel free to comment below, and I will be happy to answer them when possible.